Okay, so now let's try to understand about the sales return and its real world examples. So we know that the Nike sells sneakers directly to the customers in its retail stores because there are a lot of retail stores. Now what happens is, like in the case a customer purchases sneakers for $500 and that customer pays the value, or I can say money, in cash, then, and the sneakers original cost to Nike is $350 to produce, then what accounting entry will Nike make? So you know that this $500 have been sold for, so they have received a cash of $500, so they will say that this is our cash, and what they will credit, they will credit the revenue because this has created a revenue for Nike. Now, if we see from the P&L perspective, what will happen, that this inventory worth 350 has also been reduced from Nike's, I can say, inventory, right? Because this has been sold, so this has been reduced from the company's, I can say, inventory as well. So when our assets get reduced, what we call as our assets gets reduced, we credit them. So we will also pass another entry. The entry will be crediting the inventory that we know because our assets has been reduced. And what we will do, we will be debiting the cost of goods sold because this 350 is our cost, and we know based upon accounting rules that all the expenses and losses are debited. So this cost of goods or inventory is our expense, so this has been debited. So the entry which will be passed is like cost of goods sold to inventory. And why this entry has been passed? Because we know that when the goods are sold, two important things happen. One is receiving the money, for which we have passed first entry, cash to revenue, and second, the inventory will be reduced. This always happens together. So we have debited the cost of goods sold and credited the inventory. Now, along with that, let's see another example where the goods are returned. So if we say later the customers return 20% of the purchase because of the defect. So basically this was not a specifically, I can say, one shoes. This may be like 10 shoes. Okay, not $10, let me correct it. This may be like 10 shoe. Okay, so if we take the scenario of return, so we say there is a return of 20% of the purchase because there might be some defect. So out of those 10 shoe, 2 shoes are returned. So what will happen, that 20% of the revenue, 20% of this 500 revenue is $100. Similarly, 20% of this 350 cost is $70. So what will happen, we will simply go and do a sales return entry, right? Because here we have recognized the revenue of 500. Now we have to reverse it. So what we can call it, we can call it as the sales return or sales return allowance, whatever you want to name it, for $100. And for that we need to pay the $100 back to the customers. So we have credited it with the cash, so $100 is credited here. Now you know that out of these 10 shoes, 2 shoes now again will come to your store and they will be stored, right? So inventory for you will again increase. Now when the inventory, or I can say assets, increases, then what will you do? You will say my asset gets debited. So you will debit the inventory by $70. And what will happen here, you have debited the cost of goods sold while selling the goods. Now when you are getting the sales return, so it means your expenses are getting reversed because those expenses have not been incurred on that sale. So simply you will reverse it by doing the credit to cost of goods sold by this $70, because this $70 specifically belongs to return of goods. So this was a basic or I can say very small concept about sales return. Now let's see the same thing into the textbook. So the textbook simply says that customers may return goods after the sale is recorded. So you have sold and they have returned after that. Then what will happen? You will create a sales return allowance account or simply sales return account where the revenue will be reversed. We have seen that. And the general entry will be what? When you do sales, on doing the sales, you credit the revenue, and when the sales return happens, you need to debit it. So you will be doing debiting the sales return allowance. And what will happen? You need to pay the cash to the customers back. So you will be crediting the cash. Also, on the sales return, your inventory will again increase. So you will debiting the inventory, and your cost of goods sold will be credited as we discussed above. Now, this there is a situation like of a case of a refund liability, wherein if you haven't uh, given the goods but you have recorded it as a liability, then you will be doing debiting the liability instead of sales return allowance. This is a separate concept which we will covering at some later point of time about the refund liability. But overall, for the sales return, I believe you have understood the concept.